Okay, welcome back everyone to the Wealth Stackers community call. Today, gonna go over a new feature and just the overall way we think about Stack and why the new feature exists. So the idea is around share my screen. As you may have seen, use your money twice is the idea where you're you're spending money anyway, whether it's investing or spending. You could be spending more, borrowing to invest or borrowing to spend. So use your money twice means you're going to use the money one way. Now you can use your money two ways. And what Stack does is it allows you to do that with safe leverage. So today I'm going to basically break down the full idea for anyone who's new to the platform, but also for customers who are currently using it that are still trying to understand it because it is a pretty new concept for most people. But I did get on a call yesterday actually with a customer that does this with stocks. And she mentioned right away, she was like, "Oh, I do this already with stocks. I just bought a property by putting money in stocks, borrowing and buying the property." So again, borrowing to invest, whether it's invest in Bitcoin and Ethereum more or invest in other assets, you could use your money twice. So let's start out by who's this for? Who wants to use their money twice? Of course, everybody should, but what we find in our data and in our, experience in marketing, it's mostly business owners. Um, I think that has to do with, just more understanding of financial concepts like where we built. I was a business owner, so I am a business owner, but I've been a business owner many times, so I've learned these things. Um, I was a real estate investor too, and real estate investing, they are the ones who understand this concept the most because you can't really buy real estate, most people, unless you take out a loan. So that makes sense. And then professionals, people who are making a lot of money and want to invest more. My goal is for everyone to use this, but right now, these are the people that are mostly using it. Anybody can use Stack. I built it. So if you have $10 a month to invest, $5 a month, $50, $100, $5,000 a month, you can use Stack. Primarily, most of the people we see have already set up some type of dollar cost averaging. If you don't know what dollar cost averaging, it just means you're bringing in money often. You're not just trying to catch the market one time and become rich. This is kind of where, most people who invest, unfortunately, they bring in money one time and they expect to be rich, one day, but nothing really works that way. Everything is about consistency. So Stack is also built on consistency. The more consistent you are, the more you win because the more you're adding to your equity and the more. So if Bitcoin grows 20% in a year and you put in $1,000, you make $200. But if you put in $100,000, you made $20,000. That's a big difference. And the more you bring in month over month over month, the more you're growing that amount. So, of course, the major user type for us and person who's using this is a person who is trying to grow assets without much interaction, people who don't want to trade because what I am trying to stay away from, and yes, early on and even now, people who are day traders, they use Stack because they understand the market. They're gambling most of the time, but they know it's like an educated gamble for them. But I do worry a lot of times about those people, those types of users. We're really not a gambling platform. I know if I would have created this in a gambling way, Stack will be much more have much more users because most people do want to gamble, but I just don't want to build something that I know is more than likely going to lose people money. And Gambling is just that. Like if it wasn't gambling, even if you're a really good gambler, they kick you out of the casino, right? And that tells you something, like it's built to lose. And if you are winning, they kick you out. That's regular gambling. But when you do day trading and stuff like that, you are trading against billions of dollars of people who know what's going to happen. So I just don't want to build something that makes people think about gambling. I want it to be just a consistency that they just continue to do and continue to stay diligent with. And it's not for people who think, "Oh, I'm bringing money right now, and then by the time Bitcoin gets to 500K in 3 months, I'm gonna pull my money out." Because what ends up happening is those people are trying to time the market, and most of the time they get it wrong. It's been almost 3 years now, and I just seen this go wrong many times. People bring in money like, "Oh, I'll bring in a big amount right now, so in 3 months, when number X goes to number Y, I'll pull it out and I'll have this money." And it doesn't really work out that way because everybody's thinking that. So again, the big traders trade against you for that to not happen. Oops. So the core problem is you work hard, but most of the money goes to bills, taxes, and overhead if you own a business. As we know, I mean, I've had many businesses, millions of dollars have gone through my bank accounts and right into expenses and taxes, and it sucks, right? And I really wish I would have understood this earlier. Of course, it wasn't possible earlier. All of this pretty much just became possible a few years ago, really. It was kind of possible 4 years ago, but a lot of the systems we had to build weren't. So I did have people doing it by hand. But again, in the middle of the night, a crash could come and wipe you out. So a lot of what we built is to protect that. And also, if by any chance something doesn't work out and we can't protect, so a lot of times because people are gambling in their wallet, something can be liquidated, meaning they take some of your collateral to pay back your loan. We've even figured out how to regain a lot of that. So by using this, you are using leverage in the safest way. We're trying to build the safest way to use leverage, basically. And that will open up a lot of opportunity, we think, for people all around the world. So, net result, you're spending thousands every month. Everybody is. But most people are building little to no assets. And what Bitcoin and Ethereum and a system like Stack allow you to do is to build a lot more assets with the same amount of money you're spending. So we are really focused on growing that knowledge and having people try it out. You can try it out with any amount of money. So what's the big promise here? With Stack, what we figured out is for every dollar you're about to invest, you can invest 3.5 times more. So if you're going to buy $100 of Bitcoin Ethereum in Stack, you can instantly deposit that $100. We can borrow from a lender, from a decentralized lender, $250, add that to your collateral. So now you have 350 and you have a $250 loan. And then over time, that $350 with the $100 of net worth, Bitcoin and Ethereum will do its thing. And as it grows, we will take that profit, repay the loan. If it starts to fall, we will start to repay that loan as well and sell some of the Bitcoin and Ethereum to protect your net worth as much as we can. But the more consistent you are, the better off this is. And that's partly why we connect it to monthly bills. Because if you are doing this consistently, just like any form of investing, if you're lucky enough to have a pension or a 401k, this is exactly what your job is doing for you. Every month, they're putting money into the market consistently for decades, hopefully, if you work at the same place for that long, or if you work for that long. And what that ends up doing is it takes more advantage of the ups and the downs. Uh, and with Stack, we have the rules to protect the liquidation and downs. We just had some of the biggest crashes in history happen over the past few months. and Stack protected all of our wallets. So we are seeing that the system is being tested at the, at the heights that we didn't even expect, and it's still working out very well. But the goal here is for me to make people understand that this is not a short-term thing. You have to think about investing in a decade or decades long way. Because if you don't, then I believe that's gambling. If you think about startup investing, startup investing is a 10-year journey. When they put money into the OpenAIs, the Coinbases, the Stacks, they expect to get a return in over 10 years, 7 to 10 years on average. If you invest in real estate, you don't invest in real estate most of the time unless you're doing a flip, which is again a gamble. You expect to get your real estate money back in 10 to 20 years, maybe 30 sometimes. If you do a mortgage, you're taking a loan that you're going to pay back for 30 years consistently every month for 30 years, or the bank will take your home. That is investing, long-term, consistent dollar cost averaging. So normal DCA versus stack in a 10-year view. The idea is in 10 years, there'll be multiple cycles. So in a cycle, there's the big drawdowns. And what happens in big drawdowns is you could build up a nice stack. And I always talk about customers I've had. I had a customer who bought Bitcoin when it was $60,000 in 2021. They didn't. Stack was non-existent at that point, but that's what they did. And Bitcoin went down to $20,000. So that person had 120K. They bought two Bitcoin at 60,000, and it went down to $40,000 over a while. So if that person would have needed money in that moment, they couldn't, they would have to sell the Bitcoin at a huge loss, right? But what Stack has done is that person, when they had $120,000 of Bitcoin and Ethereum, they could have borrowed, had that cash just in case they needed it, and Stack would have protected the fall. So it wouldn't have allowed it to fall all the way to 40K of value because it had a loan. So let's say they borrowed 90,000 from the 120. Let's make the math easy. Stack wouldn't allow it to go below 90,000 because it keeps the collateral higher than the loan. So it would have forced them to keep the value of the Bitcoin and Ethereum. It would have sold to protect that and then allowed them to buy more at the bottom. And they still would have had the cash that they spent, so they would have taken risk off, had cash to spend, and still kept their gains. So that's where, by doing that, what ends up happening is you end up with 3.5 times more you're buying. Yes, through ups and downs, it doesn't always stay 2 or 3x. Based on what happens is we start repaying the loan. So now your net worth grows, but at the same time, sometimes it goes down if the prices go down, of course, but it basically becomes more of a percentage of your loan, but ends up being in the very beginning, you get 3 times more than you're bringing in. And then based on how the market does, you win early or you win over more time. What ends up happening is if you're not as consistent, you will most likely, this is what we see in the data. We have hundreds of customers at this point, hopefully soon thousands. We see that most people who don't have auto deposit set up, they're bringing in money at the heights. They're bringing in money whenever the price is the highest, and that has to do with just market FOMO. You start hearing more about Bitcoin and Ethereum. That usually means the prices are going up. People are saying, oh, yeah, it's going up. It's probably going to go up a lot more than it is right now. But that's how these traders and gamblers think. And the top traders in the world benefit from that thinking. That's when they sell, push the price down, make you sell to them, and they've profited, and then they bought it back from you at a lower price. So what we try to do is we try to sell as soon as they start selling. Because we all know it, there's going to be bull runs. There's going to be ups and downs in the market. the whales are going to sell. So when they sell, that means we are going to sell because we want to protect the profits you made or protect your equity. So this is where the risk managed borrowing works. So how does stack work in plain English? I know this is a big question a lot of times when I get on calls early with customers. Think of stack like a real estate purchase. You buy a house, right? You either have the money to buy the house outright. So let's say you have a $500,000 house you love. You either have 500,000 to buy it cash, or you have a down payment of usually about 20%. So you have 100K to bring in, and then the bank lends you 400K. So now you hold this 500K asset. Either you paid 500K upfront for it, or you borrowed 400K for it, and you still own the 500K asset. Then this is where there's two sides to this. If you bought it cash, you have options. The bank can lend you money off of that because now you have a 500K asset that is collateral. So you could borrow different levels for banks. Maybe they'll lend you 400K on the 500K asset. And then you have to pay that loan back over 30 years. This is what wealthy people do for tax purposes mostly. Then on the opposite side, you put down the 20%. Now you got to pay back the 400,000 over 30 years. Same idea, just different ways of doing it, whether you have more or less. With Stack, we do the exact same thing. You can bring in $500 and then borrow $400 or whatever the LTV is at the time. They do change, but right now you can borrow about 70%. So in that case, you can probably borrow about 350, something like that, off of 500. So if we take that idea, you bring in the 500, you borrow 350. Now you can bring in money every month and keep growing that, repay the loan if you want. There's many options. On the opposite side, you may not have the $500 or $5,000 or whatever number, $1,000,000. You can bring in an amount, borrow, and then start paying down that loan, right? Or bring in money and keep growing that net worth over and over every month. You do that for long enough, and you'll get to a position where you could either borrow more to spend or borrow more to invest. And we've seen so many cool stories. I tell the story of a customer who brought in 30,000. They brought in 30,000, borrowed 70,000. Their net worth grew to 75,000 from 30, and they were able to borrow. What'd they do? They borrowed 25K to invest in a restaurant, and they borrowed another 60K to invest in Bitcoin and Ethereum. That's the power of leverage, especially when it's protected and you have to worry about liquidations. And that person has not been liquidated no matter how crazy the market has been going. We have been protecting that wealth and slowly growing it. So that's how it works. So the difference here is with a house, if you don't make the payments, the bank is going to take your house. Here, if you decide, I can't do it right now, I need like 5, 6 months where I can't bring in money into Stack. Stack just keeps rolling. What it'll do is I'll show you the flywheel. What Stack does is if you deposit immediately, you can borrow more. So I just brought the example. If you put in 100, borrow another 250, now you got 350. And as the market is going up and down, we're protecting. But once your health score reaches a certain amount, because we're either taking profits or repaying the loan, whatever the case may be, you can automatically borrow again. This is a new feature we're working on. It's about to launch soon. But we can automatically, whenever your health score gets to a certain level, automatically borrow more. So this, what I like to tell people is, especially in the real estate world, imagine the bank automatically lending you money every time your real estate reaches a certain level of value, or you pay off a certain amount of your loan. But not only do they lend you the money to buy real estate, they also buy it for you and manage it for you. And that's what we're trying to build here. So what ends up happening is because your health score is growing, it's more than likely that we've taken profits on the way up and now the prices are back down. So we're borrowing and buying more at a lower price. So you're taking the ups, taking those profits, prices are falling, buying more, borrowing plus the money you already have to buy more and more and more, creating a loop just over and over. And if you decide you can't deposit more money, we still do that loop. But the more money you deposit, the more you grow that equity and that net worth. So that's the core of the product. The new thing is the auto borrow. And it's almost ready. We're testing it internally, but it's pretty cool. So how does it work? If you whether you have a stack or you haven't done it, it's pretty easy. You can either create a wallet or connect a wallet. You can have a MetaMask, a Coinbase wallet, a Ledger, or what's the easiest is you can just use your email. And we work with a company called Privy.io, where they create a wallet that connects to your email that you have the keys to. It's all self-custody. Then you can choose how much you can do. What we try to do is get people to pick a number they feel like they can be consistent with over a long period of time. Because a Bitcoin cycle is normally 4 years. That could change, yes. But overall, Bitcoin cycles, they always say nobody has ever lost money holding Bitcoin. So we can get you to do this for 4 years consistently. Not only will you not lose money, you will make more because you borrowed more and you protect it at the heights. That's not financial advice, but that's what the business is built to do. I've done it by hand and then I built the software to do it. So the next thing is this is not in there just yet, but we're working on a way to pick how you want to stack. Do you want to be conservative, meaning you want to invest slower, protect more often? Or do you want to be aggressive, meaning buy faster and allow more volatility? So we are working on a way where you can just choose those options and then it would just be set it and forget it. You can set a dollar amount to send every month. It knows your settings and it does what it does. We are looking though at a second option, which means if you decide to be consistent, but you're not able to. So let's say you're consistent for 6 months and then you lose your job, which is happening more and more in the age of AI, but also there's a recession. We would, again, hasn't been built yet. I want to talk to the community and see what you think. We'll start to repay your loan more aggressively because if you're not consistent with a loan, the interest grows of the loan, so we want to make sure we lower that amount as much as possible. So we're looking at that as well. And if you're watching this and you're a Stack customer, please let me know what you think about that because I think it's a way to protect even more if you can be consistent. So how does the health-based auto borrowing work? So the way it works is every day we make a swap for you. If you're a Stack customer, you know this. Every day we look at how much you have available to invest and we make a swap. So what that means is we turn some Bitcoin, some USDC into Bitcoin and Ethereum once a day. But if your health score is high, we can borrow more. So what we're doing now is, and this again, I'm not ready, it's almost ready. If your health score is at a specific level, we'll borrow more on that day to invest more. If your health score is not at that level, we won't. So what that'll do is if you're starting out or you just borrowed a big amount of money, you may have a low health score, so we can borrow more than you've already borrowed. But as Stack does what it does and we grow the health score, we can start to borrow more to buy more for you. And again, you can have that choice. It's not going to be default, but we think this is going to be a game changer for every Stack customer. And we look really forward to seeing how everybody loves it. So if you're new to Stack, there's really two options here. You could either schedule a call right away to jump on with most likely me right now. I'm taking all the calls as a founder. I really try to learn from new customers, current customers, future customers. Um, and we do a call where I just assess what you need and create a small test for you to do. And then once you like it, you can go further. And then if you want, you can learn more by downloading our protected leverage BTC blueprint. And there'll be links for that wherever you're watching this. So that's pretty much the presentation, but I also like to give the common questions I get. The common questions I get are, can I lose everything? So in normal leverage, you definitely can. So when you look at like trading platforms where you can take out leverage, there's Hyperliquid, there's I think Binance, all these places you can do leverage trading. Those places, when you get liquidated, they will take your funds. They're very low upfront cost, mostly because they make more their money when you get liquidated, right? So you'll see, in the news, $1 billion liquidated from the Bitcoin market. That is those platforms liquidating people. What Stack is built to do is not have that. And I was speaking to somebody on a Sunday night, and I told them what we figured out though is here's how it works. What is a liquidation? A liquidation is you brought in money, you borrowed more. So you have a loan and you have collateral. What a liquidation is, it's taking that collateral to pay off the loan, right? So as the prices are falling, it keeps liquidating you until you end up with nothing. What Stack does is it sells before the liquidation. So as the prices are falling, it will keep selling to protect that loan. But what is it really doing? It's taking part of your collateral to pay off your loan as well. But what we can do is, let's say our platform, some black swan event happens and our platform doesn't protect the liquidation. What we can do is we can reborrow that money. So let's say you got liquidated for 10,000. If your health score supports it, you could borrow the 10K again. So that's a way that, again, our platform is really working to make safe leverage. And we've done this many times already where people not got liquidated, but they paid down loans and they wanted to grow them back. So they were able to just go in and say, okay, I see it paid down 20K of my loan. My health score supports it. Let me take out another loan to regain that loss. Or I've had people borrow more money than they brought into the system. I had one woman who brought in $7,000, borrowed 2,000 to buy a computer. Months and months passed. We repay the loan. She has about like a $400 loan or something like that. The asset now is worth 10, and she borrowed another 7,000. So like she borrowed 9,000 and she only brought in 7. And again, that's the power of setting and forgetting. And she was a little consistent. She wasn't super consistent, but she did catch a good bull run in a good couple of months where she benefited from it. But that's where the bear market is so important here. The more you're putting in during a bear market, if bear markets are still what they used to be, when the prices go up, you make more money. So this is where like it's about being consistent mostly. What if BTC and ETH drop 80%? I just told you. When it's falling, if it's falling, we will sell all your Bitcoin and Ethereum we have to protect that loan. So if you have a $700 loan against $1,000 worth of Bitcoin, we will sell all of it. And even if that leaves you at $800 of Bitcoin, I mean, at USDC against a $700 loan, it depends on how fast it's happening. That means you still got your $700 you can buy back of Bitcoin and Ethereum. And if you bring in money at that moment, even better. So no matter what happens, we will sell all of your Bitcoin and Ethereum to protect. And that comes from the thought process that I brought up earlier in this call. The big guys are going to sell eventually. They're not going to tell you. They're going to sell. So when they sell, we sell. And if they sell hard and they keep selling, 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 so do we. And sometimes that doesn't work out because it comes back up really quickly, but you never know when that's going to happen. So we rather protect, because if we don't protect, you will get liquidated. So we have to do what we have to do to protect that loan. So that's what we do. Can I access cash without selling? You can. You can borrow off of your Bitcoin and Ethereum. We sell to protect your loan. You could choose to be more aggressive and not have us sell as often. But again, there's a pro and con to everything. There's no silver bullet. What that means is you can borrow and not sell, and the prices can go up and down. When the prices go down hard, you will lose more money because we are protecting later than we normally do because you're allowing more volatility. And if that doesn't make sense, please ask. I'm trying to figure out how to explain this in the simplest way, and I'm working hard on it. But I know it's still confusing. Do we control your coins? Does Stack control your coins? I know because we swap, it seems like we control, but we can only do a few things, and you can see it in the smart contract. The smart contract is a public document that controls what we do. So in our smart contract, you can see we can only do a few things. We can dollar cost average based on what you've chosen. So if you deposit money in your settings, and now you can dollar cost average $100 a day, we can trigger that $100 a day swap. We can protect your loan. So when the prices fall, we can protect your loan. We cannot pull money in and out of your wallet. We can only do what you allow us to do, and you set the settings. So what Stack does is we pick an automation, and what we're starting to do now, and this week we had a major breakthrough on that. We're starting to take our strategies and back test them throughout all types of timelines to see which strategies work better in what types of markets. So what we're going to do is we're going to allow you to allow us to pick the best strategies during the market types. And again, we're very early on that, but we're also going to allow you to see what that strategy could have done. And then you could switch to it if you want. But again, like I spoke about earlier, if you're planning on being consistent and then you change your mind or you can't, we would have to switch strategies to protect your wallet. Because if you're on an aggressive strategy and then you stop, that's not good because the market is falling and you're being aggressive, you're more likely going to lose more money. So we should change that strategy. But again, these are all options that the community can tell us they want, and it's not going to be default. You're going to be able to choose them. But where all we do all day, every day is figure out how to make leverage safe, because leverage is good in every other part of life. There's no reason it can't be good in trading Bitcoin and Ethereum and long-term investing for your retirement. And that's what we hope to do. So if you watch this and you are interested, the links are wherever you're watching. They probably are below the video to either schedule a call or to check out the blueprint. And if you want to reach out, you can join the community. It should be wherever you're watching, and ask questions. Thank you, and hopefully see you next time.